Yo, man, what's going on with it? We about to be diving into some real game about the stock market, investing, and trading in general. So let's get into it. We got day one. So we're gonna get this, we're gonna split this up into a 15-day course. Every day, I want you to take your time. I want you to go through each course. I mean, if you go through it, everything, and you kind of already know these things, you kind of just want to get a brief understanding to get some game that you might feel like you might need. And that's that. But if you're definitely a beginner, I want you to take your time and for that whole day, just go over this one course because you need to learn this thoroughly in order to become a master. To become a master at something, the sky's the limit. The sky ain't the limit, but that's what people like to say. So, day one, what is a stock market? Just before we get into it, I want to let you know I am Zay. I've been into trading and investing for going on 3 years now as of 2025. Made some good returns. I think the best trade I ever had was over 130%. So, you know what I'm saying? We go get into it. We go give you some game. I want to try to make this money. I want to build a good community. So let's get into it. All right. Day one, what is the stock market? What is stock market investing? Sorry about that. Okay. All right. What is the stock market? The stock market is a marketplace where investors buy and sell ownership stakes in the companies called stocks or shares. It's where public companies raise capital and where investors can profit from huge price fluctuations and dividends. All right. The stock market is a marketplace where investors buy and sell ownership stakes. So, your favorite companies like Apple, Microsoft, anything, Tesla, all of these companies, these are actually companies on the stock market, right? And with these companies, you can actually be an owner of this company. So, like how Elon Musk, they might say Elon Musk has made $33 billion today. He didn't actually pocket $33 billion. His company went up in value $33 billion. And why? Because he has a huge ownership in Tesla, which is his company. Okay? So you can own these companies. So these companies that we use, you got the iPhone, you buy a new iPhone every year. You spend that 1,000 faithfully every year, but you don't make 1,000 or 2,000 or 10,000 faithfully every year from Apple. Something not adding up. How we spending money with these companies, but we're not making money with these companies. So that's all gonna change today. Okay. It's where public companies raise capital and where investors can profit from price fluctuations and dividends. So, public companies raise capital. So, say for instance, if I have a private company and my private company is Black Market Academy, and I'm like, you know what, man, we want to raise some money. We feel like our company right now is making $100,000 a month. So $100,000 a month is 1.2 million a year, and if we did that times 10, it's about 10 million. So our company, we can see it being, worth 10 million. So we can either sell it off to people, we can sell our company for 10 million, or we can put our company on the stock market, and the sky's the limit. As long as people like our company, they like our profit margins and all the fundamentals of our business is good, we can raise way over $10 million within that company. Maybe become one day $100 million company or $1 billion company, and that's how people get rich. They build businesses and they put them on the stock market, and these companies grow because everybody invests into these companies, and they become multi-millionaires or billionaires. So that is what the stock market is. Okay, so you have the different types of stocks. We have common stocks and we have preferred stocks. Common stocks represents ownership in a company with voting rights, while preferred stocks gives fixed dividends and priority in case of liquidation, but typically without voting rights. Okay, so one thing we're gonna know when it comes. All right, so when we talk about stocks, we usually talking about common stocks. Rarely do we ever really touch into preferred stocks. That's a little bit more advanced. Common stocks is what we like the regular Apple shares and all that. We'll get into common stocks. So when you start to have ownership in these companies, you actually get voting rights within the company. So it's kind of like crypto. If you guys are familiar with like decentralized finance and the DAOs, the DAOs, the decentralized autonomous organization, you have voting rights depending on how much of that token or how much that stock you own. So, say for instance, if Apple was like, okay, we want to change this policy, or we wonder if we want to either put money to drop this iPhone 15, or if we want to come out with the next iPhone hologram. If they give you that right as a voter, then whoever has the majority of stake has a higher voting power. But overall, the actual owners of that company get to vote for the direction of the company. So you actually really have a say so when it comes to this company for the most part, which is that's insane. People don't even know this exists, and the fact that they don't even know that you can even vote for the direction of the company is insane. Like you actually have a say so on where that company goes. Okay, growth versus value stocks. Growth stocks are expected to grow at a faster rate than the market, while value stocks are considered undervalued and often pay dividends. So growth stocks are like the Magnificent Seven. If you ever heard them people on CNBC or the news say something about the Mag Seven, the Mag Seven is you got Apple, Microsoft, Nvidia, Tesla, Google, Amazon, and Meta. Oh my God, I know on the top of my head. Come on, stop playing with me. So those are the Mag Seven, right? So these are basically the growth stocks. These stocks rarely pay a dividend. And if you don't know what a dividend is a salary, basically a salary that the company pays you for holding it. So not only do you get appreciation, which means an increase in the overall value of the business. So if the business goes from 10 million to 100 million, then you got appreciation. So your worth is from 10 million, now you worth 100 million. That's appreciation. But you also can get dividends, and that's a salary that they actually pay you straight to your pocket. So that's like basically it's a salary. So value stocks pay you a dividend, right? So that's stocks like Walmart, Costco, more of your cash-heavy businesses, right? They pay you a dividend, so they might not grow as much. They might not get you the 100% return a year or whatever, but they pay you in consistent income that you know that's coming in. So that's different. That's the difference between growth stocks and value stocks. Which one is better? All depends on your goal. Are you trying to grow your 10 million to 100 million within a couple years, or are you just looking to put your 10 million in and get you a steady income coming in so you can quit your job, retire? So that's kind of whatever your goals is for investing is going to depend on whether you choose a growth or a value stock. How stocks are traded. Okay, this one's simple. Stocks are bought and sold on stock exchanges, and trades are facilitated through brokers. You can invest directly through brokerage accounts or using investment apps. Okay, so exchanges are like this. This is the New York Stock Exchange, right? So that's Wall Street. Have you ever heard of Wall Street? There's an actual street in New York called Wall Street. That's where the New York Stock Exchange is at, right? And it trades are facilitated through brokers. So brokers are like how you have a bank account, Capital One. You might bank with Chase. You might bank with Bank of America or Wells Fargo. God bless you if you bank with them. These brokers are basically like those. So you have TD Ameritrade, which now became Charles Schwab. Okay, so you got them. You got like E-Trade. You got Ninja Trader. You got Robinhood. You got Webull. So these are brokers. They're basically like bank accounts in a sense, but they're for trading stocks. Some let you trade crypto, and others let you trade futures as well. You can invest directly through brokerage accounts or using investments apps. So they have apps just like your bank account. You put money into these things, and then you can start buying investments and everything like that. Real simple. Basically, just a bank account where you trade stocks. At simple. Okay, risk versus reward. This is a real good one. So this is off the gate. We're gonna give you some real game. Stock investing involves risk. Prices can rise or fall historically. Stocks have provided higher returns over the long term compared to other investments like bonds or savings accounts, but they also come with volatility. Okay. Now, I'm going to tell y'all something. Risk and volatility are not the same thing. All right. Risk, I define risk as the possibility to lose your money, right? The possibility to lose your money. The possibility for your money to be no more, gone. You know what I'm saying? Volatility is just how much the price moves, okay? So risk. If we were to invest into a bad company, say for instance, like Nike having a horrible, it's been doing bad recently. It has not been making good returns. I can show you the charts soon on Nike. Actually, show you the charts now on Nike. Let's see. Let's look at Nike charts. All right, so look. That's the 1 minute chart. I was about to say Jesus Christ. All right. Let's look at go to the blank chart. All right. As you can see, Has Nike chart been going since November of 2021? Has Nike chart been going up or down? It has been going down. Okay. The only reason a company would go down like this if it's a bad company. Okay. Fundamentals and technicals are intertwined. All technicals show you is the effect of the fundamentals. So fundamental investing is the cause and technical investing is the effect. So if we can look at this chart and see the company has been dropping for years now, for over 4 years, we would not want to get a company that's dropping over 4 years because why wouldn't it the next year drop again, right? Okay. Now, prior to this top, Nike has been going up and up and up and up. So here would have been a good time to buy. Here would have been a good time to buy these dips, etc. Right? So, with all that being said, would I invest in Nike right now? Dropping for 4 years in a row? Absolutely not. That is a risk that my money can go to zero because luck is on the way fast to zero, right? Now let's look at another company, all right? Let's look at everybody's favorite company in the whole wide world. Actually, you know what? I should put up Meta because y'all be on Instagram all day. I don't understand how y'all do that. But now, what is the risk of this, right? Now we see Apple going up for a long time. Do we think Apple's going to go out of business anytime soon? No. So would I have a worry that I might lose my money at Apple? It's not likely. So the risk is low as far as would I lose my money. Now, can you lose your money? There's a risk no matter what when you invest into stocks. Absolutely. But the risk and the reward, do you want to put your money into savings and let it grow 1% under inflation so you're still losing money? Or do you want to get, if you bought this dip, a 55% return in just a couple of months? Now, a 1% and a 55% return is two different returns. You know what I'm saying? On one thing, a million, you'll make 500,000 in just these few months. So that's 500,000 off a million. Or 1% is like what, $10,000 in a couple of, it's just, where is your money better? So if you invest into a company that you know will be around, and there's a way we can find this out too. There's a way that we can find out which companies are companies that we know have a super high likelihood of bouncing again and again and again and keep going up. Secret sauce. So this is risk. Now I'm dragging on this point because I need y'all to understand the difference between risk and volatility. Volatility is just how much the price swings. So of course, there's good, but there's also bad. There's yin and there's yang. Just like we can make from here to here, make 55% here, the volatility would be how much does it swing within a period of time. So here, we lost 15%. So if you're at a million and you invested here because you didn't know how to buy the dip, you lost almost $200,000 on this drop. But that's volatility. So you didn't actually lose it because you didn't sell it, right? You just own a company. It's just showing you the value of your company, but you didn't lose his money. Because especially if you believe that the company is within the next 10 years to be worth, say, 500, you didn't lose no money here. That's just volatility. So volatility is the price swings within price. So then again, we swung up. I'm wrong thing. We came here. Oh my God, what's going on? There we go. All right, let's do it from here. We came here. Then we popped up 19%. So we made 200,000 here. And then after we made that 200,000, the volatility again. If you would have bought here like you're not supposed to, well here really, but I'm just marking it over here. If you bought here like you're not supposed to, and it dropped again, volatility used 15% again. So this is volatility. The price went from 55% down 15, up 19, down 15. That is all volatility. So that's not risk. Your money is only at risk. Your money is at risk when you buy the stock. But depending on how bad the risk is depending on how good the company is. Okay, so that's the difference between volatility and risk. Okay. Now, last but not least, the power of diversification. Don't put all your money into one stock. Diversification spreads your investments across different sectors and assets, reducing risk and increasing the potential for long-term return. Okay. Diversification is important, but not over diversification. If you want to own more than, let's call it 5 stocks. If you want to own more than 5 stocks, you better off buying the S&P 500, right? People be owning 50 stocks, 100 stocks. What's the point of owning all these stocks? That you basically built the fund. So your return is capped. The reason why the S&P 500 on average makes 10% a year is because it has 500 stocks inside of it. So there's going to be winners and there's going to be losers. But if we found a way to only invest in the winners, to only invest in the stocks that move the market, then we're going to beat the market every single year, and that's a fact. Now, diversification is still important. We don't only want to hold one stock because there's going to be drawdowns. So how I was showing you the volatility early, we can drop 15%, up 19%, down 20%. That's volatility. So you want to hold multiple stocks, preferably from different sectors. So when one sector is doing good, even though in the economy another one's doing bad, overall your balance is pretty stable. You don't have a huge drawdown. Now, of course, every once in a while we'll have a crash or something like that, and we'll have a huge drawdown. That's bound to happen. But that's when you invest and you pretty much become super duper rich after that. You get what I'm saying? So diversification is important. I don't like to go over 5 stocks. Me personally, I have 5 stocks. If you have 20 stocks, bro, just buy the S&P 500 and save you some stress. You know what I'm saying? There's no point. So that's pretty much it on day one. Hope y'all enjoyed it. See y'all on the next motion.